Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Colati. I'm your host, and I am so excited that you've decided to join me. Hello, everyone, and welcome to today's episode. I wanted to start off today by posing a question for you guys. So whether you are listening as a real estate investor or a tax professional, there is a good chance that you have attended one or more conferences in your time. I feel like right now it is conference season, especially in the tax world. Summertime is when we've got a little bit of downtime and we can go to all of these large conferences and small local events and get our CE hours in for the year. So my question for you is, why do you go to conferences? Are you someone who does? Do you attend live conferences, or do you tend to just learn things through online offerings? And when you go to a conference, what is your main intention when you go? I know that some people will go to a conference solely with the purpose of learning. They're head down, very focused, and they're only there to listen to the speakers. And I know that there are other people who will attend a conference largely for the purpose of networking, making connections, or seeing people who they've known in the industry for years, seeing friends, and things like that. So I am very curious why you attend conferences. And second part to this question, when you go to a conference, what are some of your best tips, or what are some things that you put in place so that you can easily remember everyone you meet and make sure that you are actually making the best of it, making the most out of that time you have with all of these other people in your field? The reason I ask is I am going to a lot of conferences this time of year, and a few things that I have put into place that have been super helpful for me, and I think some of you might get value from. The first thing is, even though I hate them, I bring business cards. A lot of people still do use them or ask for them, and I try to have these handy whenever I can. Another thing that I prefer to do is, while I will give someone my business card, I would always rather receive someone else's. At the end of a conference, if someone has spoken to 500 people and you're just one of a stack of business cards, there's a pretty slim chance they're even going to remember who you are, let alone ever reach out to you or move past that conference point of sharing something useful for you or with you, or asking about collaborating on something, or whatever it might be. When you're just one person in a stack of cards, it's really hard to set yourself apart. So I would always rather be the person receiving the cards. I will take people's information, and then after the event, I will follow up with them in some way, just so that we have that secondary point of contact. I'll send them an email and reference something we had talked about, or I'll add them on social media and follow their business page, or whatever it is. I always want to be the person doing that follow-up to make sure it doesn't just get lost. I think that happens a lot. We go to these conferences, and a lot of the time they're a fair amount of money to go to these. And then we meet all of these incredible people, and then we just lose the connection. So my tip is to be the person collecting the information and take the action to follow up, even if it's something small, even if it's just a quick email or a message online, just, "It was great meeting. I hope you found that information you were looking for on this code section. If you do end up finding that case you were talking about, would love if you'd send me an email. Is there anything else I can do for you?" Just some kind of follow-up. I had heard a podcast recently talking about this, and they were saying that when they attend a conference, every time they collect someone's business card, what they do is that they write a little note on the card specifically about something that they talked about with this person or related to this person, something to help them remember. So I think this is a good idea, but my first thoughts were most business cards have a lot of text on them. Some people don't even have business cards anymore or only have digital ones. So I'm trying to think of a better way of doing that, because I would love a good way to keep track and kind of remember those little tidbits that I've talked to everyone about, whether it is their dog's name, where they're from, what they're doing that summer, what kind of tax they specialize in, what kind of investments they buy, what kind of properties they invest in, what states. Any of those little notes, I would love a quick, easy way to save with that person's information as I'm talking to people at a conference. Now, I know I can do a notes app or scan in their information as a contact and add notes, but if anyone else has a creative way they've been doing this or an app that works really well for this, I thought about maybe doing like a quick video clip with each person or a selfie or doing a voice record so it transcribes it, something like that. But if there is a good solution out there that you've already found, I would love to hear about this. So I want to hear all of your information about conferences, why you go, what you get out of them, what your current process is, and if you have a stellar solution for keeping track of who you've met and kind of just remembering all those little details about people, let me know. And so you can either shoot me an email, that's just contact@cretaxstrategist.com, or join us in the Facebook group. I will have links to both groups down in the show notes. There's a group for tax professionals and a group for real estate investors. Hop into the Facebook group, make a post in there, or send me a message on Facebook, Instagram, wherever, and let me know. Because I am trying to up my conference game this year and really make the most of all those connections with all of the fabulous people I meet. All right, all conference talk aside, today we are going to cover a topic that I've sort of touched on, and it comes up a lot because it is incredibly popular in the real estate tax world, and that is cost segregation studies. So today we are going to cover what a cost segregation study is, why someone would want to have one, kind of the expectations from one, ballparks on what they would cost or what you can expect the outcomes to be, different types of studies, and a few of the red flags or things to just be cautious about as you're doing these. I will have a follow-up episode on this soon with a little more on the cautionary tales, but today's episode, we're really just going to focus on the meat and potatoes of what makes up a cost segregation study. So in a nutshell, a cost segregation study is something that you can have done on a piece of real estate that is going to go through and separate out all of the various components of that property. As a starting point, when you buy a piece of real estate, you are often paying one price for everything. So that is your building and your land. But it goes farther. On that land, there's likely some land improvements, some fencing, some driveways and sidewalks. And in that building, there are all kinds of other components. There's flooring and electrical fixtures and appliances and the different run-in to connect appliances and things. All of these different components have a value, and some of these components are considered not structurally adhered to the property, and they can actually be listed at a correct shorter life. So what we mean when we say that is for any kind of asset you use in a trade or business that's a rental, you are able to depreciate that asset. Meaning, since it will give value over countless years, the tax code says you need to match up the cost with that amount of years. So for different asset types, there's different preset lives that you need to follow. So for residential real estate, that's 27.5 year. For non-residential, that's 39 year. And then within that, there's also, like I was saying, several shorter lived categories. So 5, 7, and 15 years are the most common breakouts. 5-year assets are going to be things like non-permanent flooring and appliances and furnishings in a property. 7-year assets we don't see too much on rentals. I believe a shed would be 7 years, but there's not much else I typically see. 15-year is going to be your land improvements. So those, again, fencing, some landscaping, driveways, parking lots, things like that, walkways, land improvements. Another option for 15-year in some real estate is going to be your qualified improvement property. So that is improvements done to the internal part of a property that has already been in service, and it does have to be non-residential property. So that's another category that is also under 15 years. The reason we like separating out these various components with a cost segregation study is that they take the depreciable life of these assets from 39 years and can bring them down to as low as 5 years. So if you are going to write off the same $10,000 across 39 years or 5 years, the amount you get to write off per year will be much higher if it's only across 5 years. Now, I'll get pushback on this, and I've had tax professionals tell me, Natalie, this isn't actually creating any more deductions. You're just front-loading them. You're taking more up front instead of spreading it out more across the 39 years. And you are absolutely correct. That is what we are doing. You have the same amount of asset value either way. We're not creating more or creating more write-offs. We're just choosing to take a bigger chunk of them in those first years. There's a few reasons for this. For me, one of the biggest ones is most real estate investors don't hold property for its entire life. Very often, real estate is not held for 39 years. I think on average, the hold time is closer to 7 years. So if you're going to own a piece of real estate and you have a purchase price of X amount of dollars and you are allowed to depreciate and write off all of that across reasonable lives as, set out, would you rather get 3/4 of that purchase price during the time you own it, or would you only rather get 1/3? So basically the trade-off is you're not going to own it for those later years. So why are we saving deductions for a time that you likely won't ever get to? So that's my first reasoning for looking at cost segregation studies. Past that, they're actually more accurate in many cases. Building is not just a building, so breaking things out is a more appropriate way to depreciate them. And then we have values for when we replace assets. So normally, if you replace the floors or a fence, or if you swap out any of these worn out items in a piece of real estate, if you listed the property for just building and land, when you dispose of the fence, you don't know what the value of the fence was as part of that building. Like, you don't know what its portion of the cost was that you're now taking off your asset schedule. You don't have that amount. So it ends up with these skewed values because we're adding a new fence, but we didn't remove the portion of the cost of the old fence. Or we're adding new floors, but we didn't remove the cost of the old floors. So we end up just adding and adding and adding to this original building cost, but the building had most of these things as part of that original cost. So it creates some inaccuracies when we don't separate them out. Additionally, not only do we get to front load a lot of these depreciation write-offs that we would normally not ever get to, but anything with an asset life of 20 years or less qualifies for bonus depreciation, which is just a fancy way of saying you can write off a big chunk of it in that first year. So for 2017 through 2022, this was 100%. For 2023, it's 80%. For 2024, it's 60%. It's currently phasing out. I don't think it'll disappear fully, but only time will tell. But so in addition to getting to push all of those expenses from years you're likely not even going to own the property into those initial years when you do own the property, past that, we then get to take a big chunk of that front-loaded expense in the very first year. So this can be an incredibly helpful tax planning tool to anyone who is able to use those losses. If you are a real estate professional and you can use them, if your income is under $100,000, so you can use up to $25,000 a year of passive losses against your other income, or if you have a large gain from real estate during a specific year, if you're selling a property for a large amount of gain, doing a cost segregation and creating a large amount of loss on a different property can offset that gain. So there's a lot of planning opportunity with cost segregation studies, because what we're doing is separating out components into shorter lives. Then we can take a big chunk of that shorter lived asset all at once. So a really cool planning opportunity. Now, more on the side of the actual what is a cost segregation study. So there's a few different types of studies, and there are multiple ways. There's 6 different ways that a study can be conducted that are listed out in the Cost Segregation Audit Technique Guide. Highly recommend you guys go and download this and read through it. Whether you are an investor or a tax professional, there is so much good information in this. The IRS literally puts out the guide to audit you. Why would you not want to know that? So in that guide, it lists out 6 different ways for conducting a study. And typically who does this study will be a cost segregation firm. Some accounting firms also do them in-house, but most common, it's a third-party firm. So of those 6 ways, the most common ways land around having an engineer-based study completed, where an actual engineer who is an expert on these topics, on these assets and their class lives, they will either do a site inspection where they come to the property, or they'll do a video walkthrough. They're going to do an actual hands-on analysis of the asset, of everything it has as parts of it, what their reasonable values would be. It is a full in-depth study, and these tend to be a few $1,000s for residential real estate. If you have a 1 to 4 unit, I see these on average between $1,500 and $4,000. On average, when you do one of these engineered studies, of that initial building value, I tend to see about 20 to 30% of that can get pushed into those shorter lives. So the engineered studies, these full studies, are the recommended. That is what I recommend to pretty much everyone. They're going to be your most reliable option. They're the most in-depth. They're the most appropriate. The next option is a DIY study. So there are websites that will allow you to just type in the property's address, the year it was purchased, the square footage, if it has carpet or tile, like a few just broad defining factors about the property. And then they use an algorithm. They're pretty much using a software of data to assign reasonable values to each of those components. In that audit technique guide, the very bottom of the list do list that there can be an allocation defined by a sampling or modeling approach, which is somewhat what this is. The very last option is sort of a rule of thumb approach, which is just looking at other similar properties in this industry, similar fast food restaurants or similar hotel chains. We tend to land at about these amounts. So very vague. Sampling is a little more detailed, where there's sort of a large sample taken and then brought down into a reasonable allocation based on the defining facts of that sample. Either of these, though, isn't specific to your property. It's generalizing. So that's what these DIY studies do. In reading kind of how they do this on one of the websites for this, what it says is that what they are doing is that it uses many of these same concepts, but instead the information is processed using their proprietary algorithm and used to generate a logical breakdown. So a DIY study does not look at your specific property. It does to a certain extent, but very high level. And to me, these are not reliable. They're very bottom of the list. They'll give you some amount of breakout, but it could be very, very, very hard to defend. And many of these firms do have an audit protection where if it is looked at, they will back it with a full study at that point. But even then, be really cautious of these. So there's a few methods to do a cost segregation study. Like I said, what I recommend is going to a firm and having an actual full engineered study completed. At the very start of this, my recommendation is before the information goes to that cost segregation firm, you and your accountant, or if you're the tax professional, you should set up that starting basis, looking at closing costs, any additional fees that went into it, all of that. Create your initial starting basis, and you figure out the land and building value. Some firms will use a standard split for land versus building, like 85-15, 80-20, whatever it is. They're going to use a standard, and that's not a reasonable method to separate land and building. So you want to give them that starting point of the building is this much. The first step in any segregation for any rental is you start with the land value. That's the first thing you're supposed to separate out. And the audit technique guide actually says to separate out its highest and best value, meaning if you have a few different things that are giving you this value, if you have an appraisal, but also a county assessor value, you're supposed to use whatever one gives the highest value to land, which is the least preferential to the taxpayer. So if you are audited and they find there's a higher land value that was reasonable, that could be adjusted. So as a starting point, you should create the land and building value, including closing costs, and provide this to the cost segregation firm. Without this, they might use a standard allocation, and also most don't loop in closing costs because different accountants will treat them differently. So then you have to be mindful of that, and you have to separately account for those on their own. The next thing that I would say to be incredibly cautious of is if you are doing a cost segregation study and you are doing this intentionally to create large losses using bonus depreciation, and you have a way to use the loss that year, this is all very intentional, make sure that there is not an election on the tax return to elect out of special depreciation or to elect out of bonus depreciation. There is an election that can be made under Code 168K that says that for a specific asset class, the taxpayer is not taking a special allowance. They're not using bonus. And I have seen this on returns before, just kind of mindlessly, where they do it as default, or they were taught to do it that way, or they just didn't know what it meant. If you make this election, it is permanent. And what that now means is that even with that study separating out those 5 and 7 and 15-year asset, they'll be on those shorter lives. But if that election is there, you cannot use bonus depreciation, and you can never go back and fix it. It's a permanent election. Once you've said you're not doing it, you can never do it on that asset. So be cautious of that. If you had a tax professional do your return, double check for that. If you're a tax professional, be leery of making this election unless there's a very intentional reason. The next little warning I'll give you guys is if you are doing a 1031 like-kind exchange and have plans to do a cost segregation on that replacement asset, there's another election you're going to want to look at. When you do a 1031 exchange as a default, what happens? That's when you sell a property that is used for investment or business purposes. You defer the gain by investing in a new property. The standard treatment after that is you technically have 2 assets on your asset schedule or your depreciation schedule. The first one is the asset you got rid of. That basically just stays there, that same life, that same amount, the carryover amount of basis stays there. So that'll be on one time frame. And then any excess basis or new basis. So basically, if you traded up, so you put in an extra $200,000 into the exchange, you bought a property $200,000 more, that new $200,000 of value starts at that new acquisition date across a new life, but you would have 2 different assets running at 2 different schedules. The carried over amount stays on its own schedule, just as exactly what it was before you sold it. And then that new extra value, whatever you bought up into, starts on a new schedule. That is the standard. That is what should be on your asset or depreciation schedule if no election is made. However, under 1.168I in the CFR, there is another election here to elect out of that treatment and instead to elect to treat both assets as one asset starting at that new acquisition point. So instead of having that prior asset still listed there at like year 10 out of 39 and a new asset starting brand new at year 0 for whatever your trade up value was, it's all going to combine into one amount starting over again at 0. So that is your other option, is combine into one asset. It's always worth looking at both to see what is better in terms of a tax benefit. But the way this comes into play with a cost segregation study is if you are doing a cost segregation study on a property that has been obtained through a 1031 like-kind exchange, only that new excess basis qualifies. So in that earlier example, only that $200,000 of trade-up value would the cost segregation study apply to, unless you make that election to treat it as one asset. Then it applies to the carryover basis from the old property and the new amount. So if that carryover basis was $500,000 and your trade-up is only $2,000, if you don't make that election, you're not getting to do a cost segregation study on $700,000 worth of asset. It would only be on the $200,000. So be really cautious with this and talk to your tax professional and make sure that if there is a chance that you are going to be doing a cost segregation after your 1031, that you look at making this election to treat everything as rolled into one new asset. The last comment that I'll add about cost segregation studies is once you have separated out all of these different assets, now what happens? So if it is the very first year asset is being listed, it is the first tax return, it hasn't been reported prior, you just obtained the property, then you can just start off the asset listing to the depreciation listing with that breakout, with all of those different assets. If, however, this property has been reported already for 10 years, 5 years, 2 years, whatever the case is, if it is not the first year and it has already been reported and you now are changing from one overall value for a building to all of these different broken out values, then most likely you will need to file Form 3115, which is for a change of accounting method. You're going to change the method from that building to all of these different broken out shorter lived assets. 3115 is a pretty in-depth form, and it is required anytime the depreciation is being changed after more than one reporting year. So what that means is if you put the rental in service, let's say right now you would put it in service in 2023, so it's listed on the 2023 tax return with that full amount for a building value, and in 2024 you do a cost segregation study, since it has only been on one return, it has not established a depreciation method yet, 2 or more to define that method. So since it's only been on 1 year, you have the choice to either go back and change 2023's return and amend it and change to these broken out assets, or file the 3115 with your 2024 return, and then the change and any net impact from that change all get reported on 2024. So you have that choice if it's only been 1 year, and you can do whatever is preferential. As soon as it's been 2 years or more where it's been reported, your only option is that 3115. And you don't go backwards. So this won't go back and amend and change your tax for any of those earlier years when you owned the rental. The full amount of change happens in the year you file the 3115. So in recap, that is the recount on a cost segregation study. We went through the 2 types of studies. There's a full engineered study or a DIY study. We do not want the DIY studies. Steer clear of those. An engineered study is what we want, where someone will actually look at your specific property. The reasons we would want a cost segregation study at a high level are to separate out pieces of that 139-year or 27.5-year asset into a breakout of these shorter-lived assets so we can deduct more during the time we own it, front load those write-offs. Double down on that by being able to apply bonus depreciation and deduct a large amount all at once. One more quick note on that, the amount of bonus depreciation is based on the year the asset went in service, not when you do the study. So if you're listening and you had real estate, if you had rentals that you put in service between 2017 and 2022, those can still get 100% bonus. So in addition to front-loading those expenses, taking that large amount of write-off, tax planning opportunities, the other really neat benefit of a cost segregation study is now we have actual values for various components of property that we're likely to replace at some point. So if we knew a fence cost $20,000 and we've depreciated it across several years, and now the remaining value of that fence is $10,000, but we have to tear it down to put up a new fence, we know that we have $10,000 of value left that we get to write off and take off the schedule because we're replacing it with a whole new fence. So having that breakout allows you to have more accurate record keeping and potentially increase your expenses because you get to remove that existing carrying value. So that is the recap on cost segregation studies. They're an incredibly useful tool. They've become much more popular in recent years. So I do want you guys to be cautious with the firm you use, what kind of study they're doing, and what the impacts of this will be. Be mindful of any elections that can come into play with it, and just look at the big picture before diving into one. There will be an episode coming up soon that will go a little more into the cautionary parts of this and what to be careful of and what to check for. But for today, that was the overview on cost segregation studies. As always, I hope you guys found this helpful. Don't forget to reach out or come into a Facebook group and let me know your thoughts on conferences. I'm still looking for the ways to best maximize my time at conferences and how to keep track of all of the amazing people I meet and amazing things I learn. So I want to hear your answers. So reach out to me. Links will be down in the show notes. And as always, if you are finding value from the show, if you've enjoyed these episodes, please subscribe and leave a 5-star wherever you listen to podcasts. And if you've really found this valuable, I would love if you would just take a second to share an episode with a colleague or friend that you think would also find value. So thanks for listening, you guys. I hope everyone has a great rest of their week, and I will talk to you next week.